Hey, what's happening, guys? Dan Darrow here with another Options and Play video update. Today, gonna get right to the point. Volatility is through the roof. We've had just an absolutely crazy few days. Market's getting absolutely crushed. Earlier in the week, I talked about what my overall opinion was of it, right? So I'm not going to rehash that just during this video. But what I wanted to talk about, something that I've talked about previously when we've had this change in character of the overall market, right? When we're in a trend, the sweet spot for my swing trades, my swing option trades, is 2 to 3 weeks. I talk about this a lot. So in a trending tape, 2 to 3 weeks is the time frame that I really like for those option trades, like those swing trades, because overall volatility is lower, right? You're not getting the same magnitude of moves on a day-to-day basis, but the action's really steady and really consistent. Now, when the trend breaks and the volatility starts to pick up, it's what it's called like kind of a 2 by 2 tape. All right. And that means like 2 days or 2 months. And those are my time frames that I'm really focused on. I mean, you could even make the argument right now that it's almost like 2 hours with the way we're moving intraday. But generally speaking, when the volatility picks up and we've broken the trend, that I'm looking at 2 days, right? And then 2 months. And really, the logic behind that is it's pretty simple. So 2 days in the sense that you don't have a lot of visibility, right? I mean, a lot of big reversals, a lot of fast action, a lot of big swings day to day on a stock. So I'm really narrowing my time frame down to like a very short period. So like 2 days, right? If you're day trading, it's even shorter, right? 2 months, right? So now instead of like that really like midterm, like the 2 to 3 weeks when you're in a trend where like really steady, consistent action, I'm going like 2 months out. So 2 months or even more if you want to say, all right. So I'm positioning like April, May, June, July, like those time frames because over like a longer period, I find that when you get these types of moves, you can position into like decent stocks, decent setups that the longer term options can be a little bit better from a risk reward perspective because the implied volatility on the short term options is through the roof. So the longer term options, while expensive because you're paying for all that extra time, the implied volatility on a relative basis is actually lower. So if there's stocks that you've been hawking, waiting for dips, like the 2+ month time frame is also like really what I like to go after onto moves like this because yes, it again you're paying for all that extra time, but at this but relatively speaking compared to like some of those really short-term contracts that are like super expensive because of the surge in implied volatility, you can get some like better deals out there. All right. Um, so you got to embrace the volatility while it's here because we don't have these types of markets very often. Two-way action, right? Like, I mean, right now it's still kind of like one direction that's down, but I imagine that after the way this week is played out, it's going to be here for at least a little while. So for me, I'm really getting back in the mindset of taking trades like quick exits, rolling risk, right? And two-way action. So definitely a better mix, bullish and bearish. And I mean that's the change of pace for the last 3 months, but we're back into that tape now. So better mix, even mix of bullish and bearish ideas. All right. So if you like these videos and you're looking for more information on options trading or more information on options education, please follow up with the link in the description of the video for more information on options and play. All right. Have a great night, and we'll see what tomorrow has to store for us because I imagine it's going to be an interesting day. All right.